Okay, for the first journal entry, May 19th, is there a premium for this case? Meaning, is the issue price higher than the face value? It is, right? And the issue price here is $9.50 for each share, but the face value tells you for each common stock is $1. So if we want to journalize this transaction, there'll definitely be cash because the company is issuing stock for the purpose of getting cash here. There'll be common stock. There's also paid-in capital in excess of par. Okay, so for this transaction, May 19th, there will be debited. There will be three accounts here: cash, 2,000 shares times the issue price. Credit side, common stock is always the number of shares times face value, if there is one face value. And the excessive part, market price minus face value, $8.50 times the number of shares. Okay, so there's premium $17,000, and there's common stock face value times shares 2,000. If we were to post this to T accounts, right-hand side, common stock 2,000, paid-in capital in excess of par, $17,000. Okay, now for the second transaction, how many accounts do we have here? We want to journalize it. Okay, what do we debit here? Cash, and we credit preferred stock, and is that all? That's all, right? Because this is a no par value stock, so there's no face value to compare against. We don't have a premium account here. Okay, so any no par stock, no par common stock, no par preferred stock, if they don't give you a stated value either, then whatever it is, the issue price goes into preferred stock account or common stock account. Okay, so you have 5,000 shares issued here. The market price is $3. Since there's no face value to compare against, we don't have a premium account here. So just 5,000 times $3, debit cash, credit preferred stock for $15,000. Okay, now for the last case here, the company received equipment. The market value of the equipment is $78,000. They issued, in terms of receiving this equipment, they issued 3,000 shares that has $1 par value for common stock. So here we're comparing what we're receiving, $78,000, that's the equipment's value, with the face value of the stock, which is $1, times the number of shares, 3,000 shares that we're giving away. So there is a difference between these $2 amounts. So that goes into the premium account, okay, which is $75,000. Okay, so debit side is no longer cash because this problem tells you that we're issuing stock in exchange for equipment, other type of asset, not just cash. Okay, so if we receive equipment, $78,000, common stock is the part of the equity that we're giving away to others, issuing stock. $3,000, so the difference is here, $75,000 is paid in capital in excess of par. So again, if we post this to T account, you have common stock, right-hand side, additional $3,000, paid in capital, additional $75,000. And earlier we had preferred stock at $15,000. So if we total it up, if we want to represent all of these on balance sheet, you'll see preferred stock, $15,000, common stock, $5,000, paid-in capital, $92,000. Okay, if we just summarize all three transactions, if we post them to T accounts represented under balance sheet, preferred stock will be just the second transaction, $15,000. Common stock, if we add the third and the first one, you have $5,000 balance. Okay, paid-in capital in excess of par, again, add the first and the third, $92,000. Altogether, the paid-in capital section, the externally generated funds section, would have $112,000. Okay. So just an example, if we posted a T account, if we represented under balance sheet, it would look like this.